success is just like moving through problems sooner. Solve one, go on to the next one, go on to the next one. So again, with capital, you can bring forward, I think, a lot of learnings in a way where you can much sooner get to like the 80-20 core of your business model, knowing there will be nuances across different geographies. So I think that, again, the sooner you have that foundation and knowledge and awareness, you're then far smarter and more strategically acute in terms of how you build the business, right? Years 2, 3, 4, and 5 on.
Representing Franchise Secrets, Eric Von Horn.
Adam, welcome back to the pod.
Thank you, Eric. Nice to be back.
We are recording this a week later. Sometimes I'll record back to back and release them in batches, but we're a week later. Last time we were talking about like how brands, franchisees could raise money. And we started out with the real basics of entity formation. And really that was a session on like what kind of entities you create, why create different entities. Today, I would like to focus on like a franchisor. They can use their own money. They can use a bank, or they can raise money. Franchisee can do the same thing. And I talked to a franchisee yesterday that chose to go into a partnership so they could build out more of them. I've done that. I've never done the raising money thing, but I think it's interesting. And I have lots of conversations out there with franchise brands and franchisees that want to raise money. So if someone came to you and they said, Adam, I've got the right entity. Don't worry about it. It's right, because they got the right advice, and they want to raise money to start a franchise brand, or they have something special and they need more capital to grow at the pace that they're growing. Where does that person even start? What should they be thinking about first when it comes to raising money?
I mean, I think the first question I always ask founders, Eric, is I think to sort of better understand their North Star, right? Where do they want to be in 5 years' time? And I think in the cases of, right, some franchisors or franchisees, they want to swing for the fence and build a massive company and build it very quickly. Others can be more comfortable with sort of like the steady Eddie approach, and they're not necessarily out to maximize growth in the next sort of couple of years. So I think there's a little bit of knowing kind of like what you want to be and what organization you ultimately want to build, that I think is going to like lead you back to what's the right way to structure it. I sometimes view capital as the kind of like as the whole, right? What do we want to do? You know, the what and the why. The how is the capital. And I think with that then to my mind will lead us to, right, different types of, do we need, to raise money from investors and have some dilution? Can we go to a bank? Can we do this through debt? What sort of level of risk tolerance are we willing to take on? So there's a lot of factors that go into it. And we can kind of like, take some of these in turn. But I think the one thing that I'm sort of like mindful of is you want to match what you want to do debt or equity wise in a way that's in sync with your preferences and your risk tolerances with the type of business that you want to become. Like the worst thing you want to do, I've seen some founders do it, is, you can raise not enough money or you can raise too much money, so that you're just creating this mismatch. So, but again, it all comes back to where do I think what can scale look like in 5 years' time? When we've got that, we can then kind of like work backwards in terms of a few different ways to think about it.
So for us simple South Dakotans, is one way to look at it, if I'm building for cash flow for myself and my family, or a couple business partners, maybe I'm building for cash flow using my own money, the bank, and I don't really have a large exit planned in 5 years, then that's one bucket. Or I'm building for enterprise value. I'm building to have, to sell it to somebody else in 5 years. And that's a different way to build it. A different type of investor would probably want to be involved in that. So are those like two different buckets, or would you like categorize them differently?
No, at the highest level, I agree with that.
Okay, where do we want to go from now? I think most franchisees, let's just kind of like, I think most franchisees are in bucket number one, or they start out in bucket number one. They're wanting cash flow. They don't really think about building enterprise value. That's why they're working in the business, not on the business. That's why they don't really remove themselves from the business, start to build something larger with a district operational manager or some type of area manager to start managing things for them, because buyers want that. Now, we've talked about that on the podcast before, and
Yep.
that's how we've built our franchises. So we built it kind of a combination of both, building it for cash flow, but putting the infrastructure in place, meaning less cash flow for us because we're hiring a manager or district manager earlier on, so that when we do sell it, the business will be worth more in theory. And that's worked out well for the most part.
Mm-hmm.
And then the other one is, you are really building to exit, and you build it differently from day one. And both franchisees and franchisors can do that. Anything else you would add to that before we kind of get into the weeds?
Yeah, I think when it comes to building a bigger business, Eric, when there's sort of like inherently, scale is sort of viewed as a non-negotiable. You obviously want to sort of do that with an exit in mind. But I also think it's one where, like, the more scalable the business, the more profitable it's going to be, and the more cash flow it's going to distribute. So even if that's a path that you're going to take with an investor, it's one where, an investor is going to have some ownership of the business, but your less than 100% ownership could still be producing more cash flow percentage wise than 100% of a smaller business. So, in some cases, and this is obviously the genesis behind partnering with any investor, where it's like, hey, 1 + 1 should equal a whole lot more than 2. Because, like, yes, they're bringing capital, but they're bringing other capabilities and expertise in a way that we can grow faster. So, my smaller part of what should be a much larger pie is larger than what 100% of this would be if it's sort of retained, if I retain 100% under my stewardship.
Just real quick on the franchisor, a typical franchisor is not building for immediate cash flow. Franchisees are probably building a bit more for cash flow. Franchisors, as they're growing, that business sucks a lot of that cash flow for future growth until you reach kind of a tipping point where there's significant cash flow, which means, there's value in that particular brand. So talk to the new franchisors out there that are thinking about raising money, not raising money, when they should think about raising money, and just kind of the downsides of being a franchisor. Everybody thinks the franchisor with the royalties and whatnot, they're just raking in the cash because they're getting all these franchise fees, which, with brokers and their salespeople or an outsourced FSO, a lot of that gets taken away. So that new franchisor out there, what should be going through their mind?
I mean, what I'd say is I think if a franchisor is thinking about different ways to expand, I generally like to do more of an internal homework exercise. And I think the first part of that, Eric, is, knowing what I know today and assuming the business, remains 100% under my ownership. What do I think the next 5 years looks like with the business? And then you can model that out. And this isn't to be overly detailed and all the caveats that come with this, right? No one has a crystal ball, but you can make some broad brush assumptions, and you could do it under a couple of different scenarios. One could be a bit more conservative. One could be, well, hey, if a few things go my way, what does more of a base case or, more of a management case look like? I think it's then worthwhile doing another exercise that would then say, well, hey, if I could get an extra $1 million or an extra $2 million, right? What would I do with that? And where would that bring up hires I may want to make? Where would that bring up investments I want to be making in the product, in the technology, something around the supply chain? I think it obviously depends on the business and the category. And then sort of through that lens, you then sort of project what could the growth of the business then look like over the next 5 years. And at the highest level, if you zoom up, and I really loved your phrasing, get out of being in the business and on the business, because I still think that applies to franchisors, is you kind of look at like, hey, what could this business be if I did have some capital, or what could this business be if I didn't have capital? And I think that can sort of frame if there's going to be sort of like a value difference between the two. That could be one that says, actually, this makes a whole lot of sense for me to actually take on an investor sooner, because I will have, less than 100% ownership. But say I give up, 25 or 30% of the business for the right partner, my 70% under this much higher growth scenario, not to mention the cash flows that are probably going to be distributed more in, years 4 and years 5, that's going to actually result in more upside for me. And actually with a partner, it's going to result in less risk. So I think at the, at the highest level, that's how I, generally like to think about it. The somewhat cynical response to your question of like, when should I as a franchisor raise capital? The best time to do it is usually when you don't need it. But, I think in the early days, it can be one where, the business can be doing well. And again, capital can just like accelerate and bring forward investments that you need to make. And I agree with you. I think it's one where, at the risk of jumping into some financial jargon, franchisors need to, when I think about like investing dollars, I always do it through a ROI lens, so return on investment. So if I'm putting $1 back into the franchisor, I try and be as prudent and as clear as possible on like, this dollar's going in today. How am I going to make a return on that dollar in the next 12 months, in the next 24 months, in the next 36 months, etc. And that's really the lens that you want to be approaching as a franchisor, because you're probably more interested, to build a high growth, durable and successful franchisor. You're right. You've got to reinvest a lot of your royalties, and you frankly need more dollars than you've got in the first few years to, I think, do the right thing by your franchisees and create a really, really stable and durable foundation in the business. So it's usually, there's upfront investments that can take 2, 3, or 4 years to ultimately realize, but that's ultimately best for long-term success of the system, which is successful franchisees. They're huge advocates. They're building on their development schedule, and, you start to reap the benefits as a franchisor. But I think if you are, as a franchisor, going in with lofty year 1, year 2 cash flow generation expectations, then I just sort of caution prudence around that, because, as a franchisor, you always want to be investing 1 or 2 years ahead of the growth that you're going to be growing into.
I love the exercise that you take people through, because you do a lot of coaching with founders, and that's such a fantastic exercise. That's one that I think every founder should do. Get out your projections, and talk to Claude about it. Claude's going to tell you how smart you are and how amazing you are. So, you need to take that with a grain of salt. But like, I would, talk to seasoned franchisors or investors, or somebody that's really good at looking at financial statements, like, a CPA, something like that, and start to understand your own financials. And then what would it look like if you had extra capital from an investor? And how would that look? Where would you be? Where would your 70% be? What's the value of that 5 years from now versus, the cost of that capital? The thing that I thought was really important that you did, or that you mentioned in there, was it's less risk. It's more, you're building something that's more durable. So less risk, more durable. I don't think that's something that a lot of early founders think about, because they're just they're in kind of survival mode.
Attention, franchisors and franchisees. There are 2 really important resources that I want to share with you that will help you avoid costly mistakes and increase your enterprise value. The first is our free Facebook group. It's a community that has over 4,000 franchisees and franchisors in it. When somebody asks a question, they get honest and authentic answers from multiple perspectives. You can join the group for free over at franchisesecrets.com/Facebook. The second resource I want to share with you is if you're a franchisee and you want to be around a community of successful Zs and other brands and in other industries, this is why I created the Franchisee Mastermind. If you want access to the best single and multi-unit owners to know what they're doing, or if you want to be around other multi-brand owners, then you'll want to check out my Franchisee Mastermind. The reason why people join is they want access to my Rolodex, my connections, to each other. They want a shortcut success, both short-term and long-term. Links will be in the show notes or at scalablefranchise.com.
And so talk about why it is less risk if you have the capital, the right capital, structured the right way, and we'll get into that, to be able to build out probably faster and better with better hires, better technology, better different things. Like how does better, more capital reduce risk?
I think more capital lets you, invest more money into the business sooner. And I'd say I'm not advocating any situation, Eric, where you're not going to have like a prudent use of capital. It's not just to sort of throw capital around for the sake of doing it. But I think generally, if there is a capital partner, it's easier to attract better talent, and getting better talent in sooner, I think, is always a good thing, because you can, you leverage from what they've learned at other businesses. And I think what you'll see here with capital and the right hires is what you can do in 1 or 2 steps, you may otherwise be doing in sort of like 4 or 5 or 6 steps, going your own route. So you can, I think, sort of like move through some mistakes and missteps that, a lot of franchisors can make when they're just doing this on their own. I think around, sort of systems and the right foundation, or with sort of like security, with the right, sort of CRM systems. Again, it's better to get that foundation from day one versus, sort of like days 2 or 3. So I think, right, there's people, there's systems. There can be certain investment in the product, depending on what you're doing. And there can be like R&D dollars, other things that do go into that. So I think it's just a way of saying, well, hey, like, let's take what's been a 2 to 3 year time frame, and let's actually truncate this into a 6 to 12 month window. So you're bringing forward the bedrock of a stable foundation from which you can then build. And I think that's, again, the way I like to coin it internally is, I think with capital, you can have a realistic shot of almost having a foundation of like a year 5 franchisor within a 12 to 18 month window. And I think that's like really exciting, because you're then setting your system up for scale. And importantly, you're actually giving your franchisees the support they need sooner. And I think certainly with an early system, and you've got some blue sky franchisees that are buying into the concept with a lot of things necessarily proven out, then you're better placed to be responsive with support, be it people, be it systems, could be some dollars as well. But you're helping the franchisor to learn faster and to learn quicker. And I think that's really important, because, I often sort of like joke with some of my clients that, people say, once I get through this problem, I'll be okay, like the conditional statement. As I say to them, I said, like, success is just like moving through problems sooner. Solve one, go on to the next one, go on to the next one. So again, with capital, you can bring forward, I think, a lot of learnings in a way where you can much sooner get to like the 80-20 core of your business model, knowing there will be nuances across different geographies. So I think that, again, the sooner you have that foundation and knowledge and awareness, you're then far smarter and more strategically acute in terms of how you build the business, right, years 2, 3, 4, and 5 on.
Love it. I just don't think enough people think about reducing risk. when they bring on capital like that. And so they think about the upside. There needs to be upside. They probably don't look at that the right way all the time, but then the reduction in risk, and I'd say even time risk. Like if you can get more franchisees, those franchisees are more successful within 3 years. That would normally take you 6 years without money, 3 years with money. I mean, I'd rather have something in 3 years that's very strong and durable and is has a pathway to exit in 2 years after that, versus something that's limping along 6 years later. You have a path to exit maybe 6 years after that. So it's collapsing timeframes, just more stability, and probably a lot less stress for the founder. And again, I've seen franchisors do it all kinds of different ways. As we're doing a brand together, Adam, you and I, and Front Street. We're not talking about it. It's top secret right now.
Yeah.
Jeff's actually going to be doing a podcast with us. I mean, we might raise some money for that. We might not, but we have the capital to be able to do it. And if we don't raise money for it, it's because we have the capital to put in and to build it the right way. The other thing that we're doing on that one, I think it's just a little side tangent, is we're not bringing it to market. We're not offering it to franchisees until it's ready. Like we could bring it to market right now. We could have an FDD and start selling these things, but we know if we hold back 6-12 months to build things with a stronger foundation, we'll be able to grow at I wouldn't say faster, because it's not going to be faster, but much more stable, much less risk in that franchisor. And that means less risk for the franchisees, less learning on the franchisees' dime, and just a stronger brand in general. But it goes along with less risk. And that's why I was thinking about that. I think you want to look at de-risking your franchise opportunity any way that you can for the franchisees.
Yeah, and I think totally agree with what you said. I think two other points around risk, and I wasn't explicit. There's also the reality in any business, Eric, like shit happens, right? External events happen. And I think there's merit to always having some cash in the bank. And I've been talking about it more for like offensive reasons, bringing forward investments, doing the right thing. There's other things like, defensive reasons. I've got a business that's got like a number of locations in New York, like with the snowstorms this winter, right? You basically, you kind of like lose 10 days of business. Things happen. Obviously, March of 2020 was an external event. There's other things that are always going to crop up. And I think the one safe thing that you can assume with any plan today is that the plan will not go according to plan. And you've got to have enough flex and I think sort of like buffer in your plan to accommodate that. I think another point on risk, Eric, I've been talking right now purely around what we sort of term primary capital. And I won't do this to get into sort of like too much jargon, but it's basically when an investor puts cash into the business and the cash goes into the bank to be used for, to be spent around investing in the business. There's also what is termed sort of like a secondary transaction. And that is when could be your investor or other folks actually buy your shares directly. So that's going to result in you, having a little less ownership. But I raise that point because I think it's a really important one around just individual, sort of like personal risk preferences. And it can be one where, there is a 5 to 7 year, 5 to 8 year path as you're building, as a franchisor. That journey can be challenging. Certainly in the early years where you're not, earning a massive salary, you're not getting, there's no profits in the business. And this is a personal preference, but if you can, sell a few $100,000 worth of stock or whatever the number is, that just reduces a lot of stress. And that I just call that like insurance for like your ability to sleep between 2 and 4 a.m. in the morning. And again, different folks are going to have different preferences. Younger entrepreneurs that have, they could have a higher risk tolerance than, somebody in their 50s that's starting. So all these things are just like highly personal. And again, I just like work backwards on, I know a number of people that I've worked with that would happily take a few ownership points less in their business to have some extra cash in their bank account along the way. And I think, you've got that psychological safety, but I think that also better positions you as a franchisor to make the right decisions for the long-term health of the brand. And I think if you're too cash strapped or you're too stressed about payroll, I think that sometimes can trigger decisions that aren't ultimately the best thing for the brand.
Yeah, I mean, franchisees, franchisors, humans tend to make worse decisions when they're under pressure, when they
Yep.
don't have the capital, and you have this entity that you're trying to build, you're trying to grow, and you're trying to do what's best for the entity. But if that entity is not producing enough capital, and you're having to put capital into the business or not take as much out of the business into your own personal lifestyle, like you are making wrong decisions many times in that business as a franchisee and a franchisor. Let's talk about just a bit of risk and reward, the upside and de-risking deals for franchisees when it comes to raising capital. Because I think here's an example: solo salons. We did it all through the bank, but I was going to do it by myself in Orange County, California. Each one was $1 million to open up. I didn't have that kind of capital back then to open them up. So I brought in 2 other partners. So now there was 3 of us. We knew we had to open up 12 of them within 5 years. That's $12 million. And then we're like, this is still going to be stressful for us trying to do this. Let's bring in a 4th partner to reduce that stress, allow us to grow faster. And so we can either, build an empire or have an exit. And we had a 5-year run with Sola, then we exited to private equity. It's the same type of thing, but as a franchisee. And so the reason I wanted to do 12 of them is because we were able to lock down the whole Orange County market early on with the brand, being able to lock down a whole market, box everybody else out. And we had the freedom to build in that market. And we knew that, one, we could have our pick of anywhere in Orange County to build these things. And then there was also white space around where we could have more territories that we could continue to grow, or the buyer could come in and grow in that market. And that's valuable as well without having other franchisees in that market. So, multiple different reasons in there. I won't get into all of them. I just got into a couple of them, but it's the same thing. We did not take on an outside investor, but in ways we did, because it was capital coming in. It reduced us by 25% and bringing in that 4th partner. Hindsight, if we could have brought in a partner that was just capital for, giving up 10% of that or 15% of that, we would have done better with that if it was just purely a capital partner, but giving up equity and cash flow along the way. So, that's partner with capital, investor with capital, is still capital. And as I hear myself talk, that was one of the main reasons we wanted to do that. And it worked out well for us. But it's easy to talk about the franchisor and all this. The franchisee kind of gets missed in raising capital a little bit. But I have friends right now that private equity is wanting to buy them out or invest capital into a franchisee entity because it was built the right way, and they want that franchisee to continue to grow. Some of my friends are like, I don't know, we want private equity coming in to and take some of our chips off the table and invest in us. And he's like, now I have a job. I don't want a job. I did this because I wanted some freedom, but at least he has options. And he's looking at an 8x multiple in that private equity is valuing their franchisee entity. So I just want to be clear with people out there. Like, we talk a lot about franchisors because I'm a lot on the franchisor side. I'm still on the franchisee side. My roots in franchising are on the franchisee side. So I think about franchisees a lot, and franchisees are building some of their empires the right way and have, access to capital, have access to exits like an 8x multiple on, multiple highly profitable cash flowing businesses. So I just want them to think about how do they de-risk and have upside when it comes to raising capital. Did I miss anything in there that came to your mind on the franchisee side of raising capital?
Yeah. No. I mean, I think a couple of other points I'd add, Eric. I think one, what you do with Solar in terms of like capturing a market, I think there is huge strategic and operational synergies that also come with that, right? If you're in a business that is doing paid spend, like you can leverage leverage investments across an area. You can share managers, area managers. Like there's a lot that you can actually get with, I think, with sort of like scale, right? And sort of like fixed costs that are spread out over more locations than fewer locations. And I think the point on private equity around monetization, as a general rule of thumb, and I'll say that because there's the asterisks, there'll always be exceptions, but if you are interested in selling, generally like the larger the platform that you can sell, right, is going to come with sort of like higher operating profit. And generally like the larger that profit, the more de-risked the business is in the eyes of any potential acquirer. And generally multiples will be higher, the more profit that you ultimately like have. So, private equity is going to be far more interested in a 10 to 15 unit franchisee than they are with a 3 to 5. And again, there'll always be exceptions around that. I'm giving sort of like higher generalizations. So again, it can serve a number of other like outsized benefits as well. That as a 25% holder in your instance, you're still leveraging the benefit of that.
All right. I want to get into like the types of structures let's say we have somebody that knows they want to raise money now. They've done the Adam Ross, exercise, investor exercise. Should I bring on an investor? Is it going to actually de-risk it and give me a possibility of better upside, greater upside? And the answer is yes. And now, like, what does the structure look like? But let's do that next week, because we've had a lot of discussion on upside, de-risking in general. I think this is a good place to end this one. So any parting thoughts on that before I let you go?
I don't think so.
Thanks for listening to the Franchise Secrets podcast. Links to everything can be found over at franchisesecrets.com. And if you want my help with anything from starting your own franchise to growing your current franchise business, please visit scalablefranchise.com.